Welcome back to the Deep Dive. Today, we are undertaking a critical mission.
We certainly are.
We're stepping out of the role of simple analysts and really into the minds of senior exam instructors.
That's right.
Our focus is surgically precise. The NISM Series 12 certification material, and specifically Chapter 3, which is all about mastering the primary market.
That's absolutely right. And for you, the learner, this isn't just about reading definitions. It's about really internalizing the systematic structure. And of course, the precise numerical thresholds that govern how capital is raised in India.
Okay.
Our goal here is to make sure you achieve true mastery, so you understand not just what the rules are, but why they exist. We need to move seamlessly through these concepts, linking every definition back to its real-world regulatory purpose.
Okay, let's do it. Let's unpack this entire structure, starting right at the foundation, the definition of the primary market itself. We need to be crystal clear on what it is and, maybe more importantly, what it isn't.
Fundamentally, the primary market is where capital is generated. That's its whole purpose.
Right.
It's the platform where an issuer, a company, or a government entity offers securities, whether that's equity or debt, to public investors for the very first time.
The first time, that's the key.
It is. And the defining feature here is the direction of the money flow. It moves directly from the investor straight to the issuer. This inflow of cash is what provides the issuer with long-term usable capital to fund expansion, pay down debt, or, acquire assets.
That distinction investor to issuer is paramount, isn't it? It's the moment a business transitions from funding based on, say, private means or bank loans to leveraging public capital.
Exactly.
And while we often think of these massive IPOs, that capital raising can take multiple forms, correct?
Oh, absolutely. The most visible route is the public offer. But a large amount of primary market activity happens through private placements.
Okay.
This involves a syndicate of institutional investors buying up large chunks of equity or debt. It's pre-identified and usually happens away from the retail spotlight.
Right.
But look, regardless of whether it's a huge public fanfare or a quiet private placement, if a company is successfully raising this capital, they must be working closely with a central guide.
The merchant banker.
The merchant banker.
The quarterback of the entire operation. Let's define their initial role before we dig into the system's functions.
Okay, so the glossary defines the merchant banker as any person engaged in the business of issue management. They are central because they gauge the readiness of the issuer. They structure the specific instrument being sold. Is it equity, a bond, a convertible?
Sure.
They assess and advise on the pricing, identify the target investor base, and manage the entire, very complex regulatory and logistical process of mobilizing millions or even billions of rupees. They bring the necessary structure and legal compliance to what would otherwise be a, frankly, chaotic attempt to raise funds.
Now we get to the why. The 8 critical functions that make the primary market so indispensable to a growing economy. Let's start with the one that speaks to ambition. Tap larger markets for capital.
This function is entirely about scale. It's about moving beyond your immediate network.
Right.
So imagine a small, successful, family-run business. They've exhausted capital injections from the promoters, from banks, from local investors.
They've hit a ceiling.
They've hit a ceiling. They need global visibility. By accessing the primary market, they can reach potentially millions of new investors, both domestically and internationally. The source material specifically mentions the example of an Indian company issuing a global depository receipt, a GDR, in the euro markets. That single action immediately broadens their capital base to institutional players and retail investors across continents who might find that enterprise attractive because of its growth story.
And once you step onto that international stage, you subject yourself to a pretty rigorous valuation mechanism, which leads directly to the second function, fosters competitive process.
Exactly. When you expose your security to the open market, whether it's through a fixed price or, more commonly today, through book building, the price isn't arbitrary. It's market-driven.
The market decides.
The market decides. And the mechanism ensures fairness. Consider the pricing of government securities, or GSECs, issued by the RBI. This is all done through a defined auction process.
Okay.
Banks and primary dealers, they bid the rates they are willing to accept, and the final issue price is determined by the market demand. This ensures the government borrows at a truly fair, competitive rate.
Function 3 addresses corporate structure and control. Diversify ownership. When an IPO succeeds, that initial ownership structure gets diluted, right? It moves away from concentrated power.
And this is a cornerstone of modern corporate governance. When ownership becomes broad-based, shared among thousands of public shareholders, it necessitates the separation of ownership from management.
You have to bring in professionals.
You have to. Professional managers, skilled executives must be brought in because thousands of small shareholders can't collectively run the company. This broadening of ownership also triggers regulatory requirements for professional oversight, like the mandatory appointment of independent directors.
And they're there specifically to strengthen governance and safeguard the interests of the common shareholder, not just the founders.
Precisely.
The need to appeal to those independent directors and public investors then necessitates Function 4. Better disclosures. If you're asking strangers for billions, you have to open the books.
The primary market imposes a dramatically higher standard of transparency than a private company ever faces.
Of course.
Investors need information that is not just adequate and relevant, but also accurate, verifiable, and presented in a standardized format. The entire regulatory framework, particularly the SEBI ICDR regulations, is built around forcing firms that are raising capital to maintain this continuous high standard of transparency. It ensures the investing public has a true picture of the company's health, its risks, and its potential.
And that transparency immediately invites Function 5. Evaluation by investors. This adds a layer of quality control that regulators alone just can't provide.
What's fascinating here is the sheer volume of intellectual capital that gets brought to bear on the company. Once the required documents, the prospectus, the financial statements are made public, they're subjected to intense scrutiny by a whole ecosystem.
Right.
Equity analysts, institutional researchers, financial media, and often, highly engaged activist investors. This widespread, rigorous evaluation helps surface potential issues and ensures that the investment decision made by the retail public is much more informed than it would be if the business remained opaque and privately held.
Function 6 is the reward mechanism for those who took the initial massive risk, exit for early investor.
Think about the journey. You have promoters, venture capitalists, private equity investors who nurtured the business through its early, high-risk, cash-burning phases.
They took all the risk up front.
All of it. The primary market, the IPO specifically, is their moment of reckoning. It offers them a crucial, predetermined opportunity to seek a profitable exit, selling their stakes fully or partially, and thereby realizing the enormous returns that are commensurate with the initial risk they undertook. It fuels the next generation of risk-taking and innovation.
Number 7 is vital for the continued faith in the market, liquidity for securities. Without this, the investment is essentially a dead asset.
This is the bridge. This is the bridge between the primary market and the secondary market. When a public issue is made, the regulations make it mandatory to list those securities on a recognized stock exchange.
Right.
This listing action opens up the secondary market, allowing investors to trade their shares freely among themselves. This guarantees liquidity, the ability to easily convert the asset back into cash without actually affecting the core capital the business raised and is currently using.
And finally, function number 8. Regulatory supervision, the necessary refereeing of the system.
Yes, every single step, the behavior of the intermediaries, adherence to disclosure norms, the rights of the investors, it's all governed by comprehensive regulatory provisions, primarily SEBI.
And the core objective is investor protection.
It is. However, and this is the vital distinction you must carry into the exam, the regulation is designed to ensure fair procedures, adequate information, and defined rights. It explicitly offers no assurance of return, risk, safety, or security.
That's a huge point.
It is. The risk of capital loss remains 100% with the investor.
Regulation ensures a fair race, not a guaranteed win. Now, let's solidify that boundary by really nailing down the distinction between the primary and secondary markets.
We are to define the primary market. The issuer raises capital, money flows from the investor to the issuer, and the capital available to the issuer increases.
The secondary market, on the other hand, the stock market we see daily, is where previously issued securities are bought and sold. So money flows from investor to investor.
And here's the exam critical point. Activities in the secondary market do not alter or modify the capital available to the issuer. If I sell my 100 shares of Company X to you today, Company X doesn't get a single rupee, nor does its capital base change.
Right.
The secondary market's function is solely providing liquidity and price discovery.
However, the secondary market does act as a sort of barometer for primary activity, doesn't it?
Oh, absolutely. When we see bull markets characterized by optimism and rising prices, issuers flock to the primary market because they can get higher valuations and favorable pricing.
And the opposite is true in a bear market.
Conversely, bear markets make primary issues extremely tough. They force companies to wait or accept much lower valuations. The markets are intrinsically linked by sentiment, even if the flow of cash is completely distinct.
That covers the structure. Let's move to Section 2, the indispensable network of intermediaries. This is a complex ecosystem, and it has to be strictly regulated. We know nearly all intermediaries must be registered with SEBI following the Code of Conduct, but there's one key exception linked to government debt.
That exception is the primary dealer. They're authorized by the RBI, which makes complete sense because their role is tightly integrated with the issuance and underwriting of government debt, which, the RBI manages.
Okay.
So let's start detailing the main players, beginning with the one we already mentioned, the merchant banker.
We know their core function is issue management. Let's elaborate on their practical responsibilities in the run-up to an IPO.
Their duties really span the full spectrum. They advise the issuer on the critical matter of pricing strategy, meticulous preparation of all issue documents, including the prospectus.
Right, the prospectus is key.
Coordinating the formal application for listing, conducting required advertising and marketing, and finally, managing the complex process of reconciliation and allotment. Importantly, merchant bankers often take on another role.
As underwriters.
Define
that term precisely for us, as it's a direct commitment of capital.
Underwriting is a contractual commitment. It means the merchant banker, or another designated intermediary, agrees to subscribe to the issue, basically, to buy the unsold shares in the event that the public subscription fails to reach the required minimum.
So it's an insurance policy.
It's an insurance policy for the issuer. They get paid a commission for accepting this risk, and it protects the issuer against the failure of the minimum subscription requirement.
In larger issues, you often see multiple merchant bankers, but one takes the helm. The book running lead manager, or BRLM.
The BRLM is the captain. They are the designated merchant banker specifically responsible for maintaining the book of demand during the book building process. Their responsibilities include guaranteeing compliance with SEBI and stock exchange requirements, coordinating the marketing roadshows, managing the critical escrow accounts where application money is temporarily held.
Then most importantly,
they are responsible for ensuring the accurate and fair basis of allotment is determined and finalized.
Next up, the meticulous record keepers. The registrar and transfer agents, the RTAs.
The RTAs are the operational backbone. They maintain the precise record of all applications received and the corresponding money. Their primary role is assisting the issuer and the BRLM in determining the precise basis of allotment.
That legally mandated pattern.
Yes. It decides how shares are allocated across different investor categories. Post-allotment, the RTA handles the physical process, processing and dispatching all allotment communications and ensuring refund orders or fund unblocking happens correctly for unsuccessful applicants.
And if they're also a share transfer agent.
Then they also maintain continuous holding records, handle subsequent share transfers, and often act as depository participants.
Then we have the specialized task of managing the financial flows, the bankers, to the issue.
Their role is specific and focused purely on funds. There are banks appointed to manage the sale proceeds. Their job is accepting all the application forms and money, which is a massive logistical task.
I can only imagine.
Processing the refund of application money to those who are unsuccessful and maintaining daily, verifiable records of every single application money received and refund issued. Since ASBA came in, their function has shifted from handling physical checks to managing blocked amounts, but the core accountability for the funds remains.
The brokers to the issue are the frontline sales force. They're responsible for procuring subscription and serving as that direct link between prospective investors and the issuer. They facilitate the submission of bids.
Moving to the infrastructure that enables all of this digital trading, we have to define the depository and its role.
A depository is essentially the central digital safe deposit box for securities. It's a system that holds the records of securities in electronic or dematerialized form. This enables all subsequent transactions purely via book entry, which eliminates the need for physical certificates.
And the mechanism for moving assets into this system is dematerialization, the conversion process, where physical securities are transformed into electronic balances. This shift changed the Indian market entirely. It massively reduced risk associated with physical paper, like forgery or theft.
And this digital system, there's a split in ownership that's important to understand.
Indeed. The depository, so that's NSDL or CDSL in India, is the registered owner of the securities on record. But the investor who holds the account remains the beneficial owner. They enjoy all the rights, the dividends, the voting power. The crucial interface between the investor and the depository is the depository participant, or DP, who acts as the depository's agent and undertakes the actual process of dematerialization and managing the investor's electronic account.
Let's shift to debt. The debenture trustees are mandatory for debt issues, and they're there to protect the interests of debt holders who, unlike equity holders, don't have voting rights.
They must be appointed before the debt issue even starts. Their primary responsibility is rigorous due diligence, specifically ensuring that the secured assets pledged by the issuer are sufficient and legally protected to fully discharge the claims of the debenture holders if the company defaults.
Right.
And furthermore, and this is an important point for you to remember, the trustees are mandated to call a meeting of debenture holders if required by at least 1/10 of the holders or immediately upon the issuer defaulting on any payment. This gives debt holders a collective voice.
We also briefly touched on portfolio managers, who are advisors and managers of investment portfolios.
And they fall into two critical categories based on their authority. The discretionary portfolio manager has the authority to manage the client's funds independently, making investment decisions aligned with the client's stated goals without needing specific approval for every single trade.
And the other type.
The non-discretionary portfolio manager. They act strictly according to the client's specific directions. They can offer advice, but they require client approval for all transactions.
Finally, let's wrap up with the primary dealers, the RBI-authorized entities we mentioned at the start of this section.
They're licensed by the RBI to participate in the government debt market. Their specific function is dual. First, they act as underwriters for securities issued by the RBI on behalf of the government, guaranteeing the initial sale. Second, they actively subscribe to government securities in the RBI auctions and then resell them in the secondary market. This ensures robust liquidity for the government's borrowing program. They operate under a formal agreement that defines their underwriting obligations and the commission they receive.
That structure of intermediaries is comprehensive. Now let's move to Section 3, classifying the types of issues and the entities that launch them. The 4 broad classifications of issues determine who the security is offered to.
The first is the most visible one, the public issue. These are securities offered to the general public, where anyone who meets the eligibility criteria can participate. It usually requires extensive regulatory disclosure.
Second is the private placement. This is more of a wholesale, targeted issue made to a select, pre-identified set of institutional investors. It's quieter, less regulatory intensive, and much quicker to execute.
Third, we have the preferential issue. This targets a highly specific, identified set of investors like promoters, strategic partners, or employees, and it often offers terms that are preferential to the public or private market rates. It's frequently done alongside a broader issue.
And the final category is unique because it's restricted only to those already invested in the company, rights issues and bonus issues.
A rights issue is essentially an anti-dilution tool. It grants existing shareholders, recorded on a specific cutoff date, the right to buy more securities at a predetermined price, which is often discounted. This is to help them maintain their proportionate ownership stake as the company raises fresh capital.
And a bonus issue.
A bonus issue, conversely, provides additional shares to existing shareholders without demanding any money. This usually capitalizes accumulated company reserves into share capital, so it increases the number of shares without affecting the total equity value initially.
Excellent. Now let's classify the types of issuers and the instruments they typically launch. This can be an area of confusion in exams, particularly concerning governments.
Let's start with governments, central, state, and local. The critical, non-negotiable fact here is that they do not issue equity capital. They issue bonds, or GSECs, and, uniquely to the central government, treasury bills, or T-bills, which are short-term, zero-coupon debt.
They also issue things like sovereign gold bonds.
They do. And since they are sovereign entities, their instruments carry an explicit or implicit government guarantee. In the Indian context, these instruments are generally issued only in the domestic markets.
Next, public sector units, or PSUs. They operate more like private companies, but with government ownership.
PSUs issue both equity shares, often through large-scale government disinvestment programs, and bonds, which may sometimes be structured with special tax concessions to attract retail investors, particularly those issued by infrastructure PSUs.
Private sector companies represent the greatest variety and flexibility in what they can issue.
Their dependence on securities markets is high, especially for major projects. They can issue virtually everything: ordinary equity, preference shares, various types of bond-secured, unsecured convertible bonds.
which can convert into equity.
Exactly. And short-term instruments like commercial paper and even complex vehicles like securitized paper. And unlike governments, they frequently tap international markets through issues like ADRs or GDRs.
What about banks, NBFCs, and financial institutions? Their access to capital is a bit different due to their primary function.
Their dependence on the securities market tends to be lower because they have access to public deposits as a funding source.
Right.
However, they are vital issuers. They issue all the instruments we just mentioned, plus certificates of deposit, which are short-term instruments. They frequently issue long-term bonds or specific preference shares that are structured to qualify as regulatory capital, like Tier 2 capital, which bolsters their stability requirements.
And finally, the specialized pooled vehicles. Mutual funds and investment trusts like REITs and invites.
Mutual funds issue units. The capital raised is scheme-specific. For example, a scheme focused on large-cap equity or government debt. These schemes are either closed-end with a fixed tenure or open-ended with continuous subscription and redemption. They are issued only in domestic markets.
And investment trusts.
Similarly, investment trusts, like real estate investment trusts, REITs, and infrastructure investment trusts and VITs, also issue units to raise capital for specifically defined schemes focused on real estate or infrastructure assets. They tend to offer investors stable, often yield-focused returns.
That categorization is vital. Now let's move to Section 4. Who are the investors and what rules govern their participation? We note the general trend. Debt markets are heavily dominated by institutional players, whereas equity sees significantly higher retail participation.
And we must recognize the sheer diversity of entities. You've got banks, LLPs, foreign portfolio investors, FPIs, Hindu undivided families, HUFs, non-resident Indians, NRIs, registered societies.
The list goes on.
It does. But for the purpose of primary market allocation and for the exam, the categorization of individual investors is governed by specific monetary thresholds. And these figures absolutely must be committed to memory.
Let's lock in those critical numerical definitions now.
The first category is the retail individual investor, or RII. This designation is given to any individual who applies or invests not more than 2 lakh rupees in a single issue.
Not more than 2 lakhs.
Exactly. The regulatory goal here is often to ensure allotment fairness for the smallest applicants.
If an individual crosses that line, they become a non-institutional buyer, or NIB.
Correct. The NIBs, also colloquially known as high net worth individuals or HNIs, are individuals or other non-institutional entities like trusts or HUFs who invest more than 2 lakh rupees in a single issue. This difference in application size dictates their share allocation percentage, which we'll detail later on.
The third, high-volume category is the institutional investors, or qualified institutional buyers, QIBs.
These are the large entities: mutual funds, FPIs, insurance companies, venture capital funds. They're regulated and require stringent internal approval processes for any investment. And for the foreign component, we must remember that those investors using foreign currency are also subject to the specific regulations outlined under FEMA regarding capital repatriation and investment limits.
Now let's pivot to the overarching regulatory framework. What are the key laws forming the legal foundation here?
The foundation really rests on a hierarchy of legislation. You have the Companies Act, 2013, which governs the formation and functioning of the issuer. Then the Securities Contracts Regulation Act, 1956, or SCRA, which defines what a security actually is.
And the big one.
The big one, yes. The comprehensive SEBI, Issue of Capital and Disclosure Requirements, Regulations, 2018, the ICDR regulations. They govern all corporate issuances. And for government debt, it's the Government Securities Act, 2006, and its associated regulations.
We need to be very clear on the regulatory split between the two main bodies, SEBI and RBI. Why do they share jurisdiction, and what are their specific domains?
This split reflects the distinction between corporate security management and money and treasury management.
Okay.
So SEBI regulates all equity public offers, corporate bonds, and any instrument representing equity or debt issued by a corporation, including depository receipts like ADRs and GDRs.
And RBI.
RBI regulates government securities, because it's the central government's treasury manager, and short-term money market instruments like certificates of deposit and commercial paper. So a simple rule of thumb: if it's a long-term capital instrument from a company, it's SEBI. If it's issued by the government or is a short-term liquidity instrument, it's RBI.
The regulatory requirements are broad, covering disclosure, reservations for investors, fund usage, promoter accountability. But let's look at the basic framework for issuers themselves. Who is legally allowed to raise public money?
The issuer must have a legal structure that is sanctioned by law for raising public money. This is a critical barrier. The entity cannot be a sole proprietorship, a general partnership, or a simple association of persons.
Right.
If the entity seeks equity capital, it must be structured as a limited company, fully compliant with the Companies Act. Furthermore, mutual funds have to be specifically registered with SEBI, and banks or NBFCs that raise deposits must get approval from the RBI.
And the instrument they issue must fit a specific legal definition.
Precisely. All securities must be structured to fit the definition of a security under the SCRA 1956, or in the case of banks and NBFCs, structured as deposits under the Banking Regulation Act or associated companies rules. If it doesn't fit the legal mold, it simply cannot be publicly issued.
Now we enter the core of the regulatory barrier, Section 5, the numerically dense eligibility criteria for a public issue of shares. These conditions are absolutely essential for exam success.
Agreed. For an issuer to make an initial public offer, an IPO, they must meet Condition 1, which I call the Big Three, based on their restated and consolidated financial statements in each of the preceding 3 full years. That's 12 months each.
And that 3-year look back is important.
It is. It's SEBI's way of ensuring stability and sustainability, not just a recent spike in performance.
Let's start with the first one, net tangible assets, or NTA. What is the minimum threshold, and what's the critical constraint regarding cash?
The NTA must be at least 3 crore rupees in each of the preceding 3 full years. This ensures the company has a substantial asset base.
Okay.
Now, the critical constraint is designed to prevent financial window dressing. Not more than 50% of the NTA can be held in monetary assets. That's cash, bank balances, liquid investments.
And why is that?
Well, SEBI doesn't want promoters raising cash from other sources, parking it briefly just to inflate the NTA, and then having it disappear post-IPO. The rule ensures assets are actually being utilized or are firmly committed to the underlying business.
Is that 50% limit ever waived?
Yes, the 50% monetary asset limit is waived if the entire IPO is made through an offer for sale, an OFS. Since an OFS means existing shareholders are selling their stake and the company itself receives no capital, the state of the company's internal monetary assets is less relevant to the IPO's immediate impact.
Makes sense. Moving to the second condition, average operating profit.
This is a measure of operational efficiency. The company must have an average operating profit of at least 15 crore rupees during the preceding 3 years. Even more critically, the issuer must have generated operating profit in each and every one of those 3 preceding years. A single year of operational loss, even if the 3-year average is met, voids this eligibility.
And the third leg of the stool, net worth.
Net worth, which represents the excess of assets over liabilities, must be at least 1 crore rupees in each of the preceding 3 full years. This serves as the basic requirement for equity solvency.
We also have the specific rule regarding name changes, which is designed to prevent fraudulent rebranding right before an issue.
Right. If the issuer changed its name within the last 1 year, immediately preceding the date of filing the draft offer document, at least 50% of the revenue for the preceding 1 full year must have been earned from the activity indicated by the new name.
So if you switch from Coal Trading Co. to Green Energy Solutions,
then 50% of your revenue better be coming from green energy activity in that last year.
So those are the 3 main criteria. But what if a promising, maybe a loss-making, high-growth company doesn't hit all 3? Say, a tech company with high operating losses but a massive valuation.
They still have a path, right? Condition 2, the fallback eligibility.
If they fail Condition 1, they're not automatically locked out. They're eligible, but only if the issue is made through the transparent book-building process and they undertake a mandatory regulatory promise.
And that promise is?
To allot at least 75% of the net offer to qualified institutional buyers, or QIBs. This is SEBI basically saying, if you can't meet our statutory balance sheet tests, you must meet the market validation test.
So if they fail to get that 75% QIB allotment,
then they must immediately refund the full subscription money to all applicants. The deal's off.
that 75% QIB threshold acts as a market stamp of approval, assuring that large, sophisticated investors believe in the business, which offsets the weak financials. Precisely. It shifts the burden of due diligence validation onto the institutional market.
We must also address the specific rule concerning SR equity shares, those with superior voting rights, often used by founders to maintain control post-IPO.
If a company has issued SR equity shares to its promoters or founders, the ensuing IPO can only consist of ordinary shares for listing on the main board. However, those SR shares must also be listed on the same recognized stock exchange, even though they won't be publicly traded. This ensures full regulatory oversight of all share classes.
Let's move to the most important rule designed to align the founder's interests with the public, the promoter's contribution, or as you call it, the skin in the game rule.
This rule mandates that promoters must contribute at least 20% of the post-issue capital. This percentage is crucial for stability. Now, if the promoter's holding is naturally less than 20%, the shortfall, but capped at a maximum of 10% of the post-issue capital, can be met by specified institutional investors.
Like AIFs or scheduled commercial banks.
Exactly. Or non-individual public shareholders holding at least 5% of the post-issue capital.
To enforce that skin in the game, that contribution isn't liquid immediately. Let's nail the lock-in periods, the standard ones first.
The standard lock-in is as follows. The minimum 20% promoter contribution is locked in for 18 months from the IPO allotment date.
18 months.
18. Any holding the promoter has that is in excess of that 20% minimum is locked in for a shorter period of 6 months.
But the lock-in period extends dramatically if the proceeds are earmarked for foundational long-term investments.
This is a crucial distinction you need to catch. If the majority of the issue proceeds, excluding any OFS portion, are earmarked and utilized for capital expenditure, and that's defined specifically as civil work, land acquisition, machinery, and equipment purchase.
Then the lock-in gets longer.
It does. The minimum 20% contribution lock-in extends to a substantial 3 years, and the excess holding lock-in also extends, doubling from 6 months to 1 year. This signals a long-term capital requirement and ensures promoters are committed for the duration of the project's gestation.
Next, the minimum offer to the public float mandate. This rule ensures enough shares are available for liquid trading post-listing and is based on the post-issue capital calculated at the offer price. These figures are complex, so let's walk through the 3 tiers slowly.
We have 3 size classes. First, for small to mid-cap issuers. If the capital is less than or equal to 1,600 crore rupees, the minimum public offer is the standard 25%.
Okay.
Second, for large issuers. If the capital is more than 1,600 crore but less than or equal to 4,000 crore, the minimum public offer is equivalent to the value of 400 crore rupees. This is often used to limit the total public offering size for extremely large companies during their initial listing.
And the very large issuers.
Tier 3. If the capital is more than 4,000 crore but less than or equal to 1 lakh crore, the minimum public offer is only 10%.
But those large issuers don't stay at 10% or the 400 crore value forever, right? There's a mandatory future increase.
Absolutely. Companies that fall into categories 2 and 3 must mandatory increase their public shareholding to at least the standard 25% within a specified period of 3 years from the date of listing. This mechanism is essential for ensuring adequate public liquidity and governance over the medium term.
Let's finalize the timeline rules. The period of subscription.
The issue must be open for a minimum of 3 working days and a maximum of 10 working days.
Okay.
Now, if the issuer decides to revise the price band during the open period, they must extend the issue by a minimum of 3 working days to allow investors to reconsider their bids. And finally, in cases of unforeseen circumstances, like a force majeure event, the issue can be extended by a minimum of 1 working day.
Now, underwriting is tied directly to the minimum subscription rule.
The underlying rule is that an issue must receive a subscription of a minimum of 90% of the net offer to the public. That's 90%.
And if they fail to hit that,
If this threshold is failed, the company must refund the entire block subscription amount received within 4 days of the closure of the issue. This short window is why underwriting is so critical.
and the mandate for underwriting varies by pricing method.
Underwriting is discretionary for fixed price issues. However, it is mandatory for book-built issues, where the risk is assumed by the lead managers and syndicate members.
But there's a key exception.
A very important exception. The mandatory 75% QIB portion, required under the fallback eligibility, cannot be underwritten. If institutional validation fails, no underwriter can artificially prop up the issue.
Finally, we covered dematerialization and IPO grading.
Dematerialization of shares is mandatory for all public issues. They must be traded in electronic form. IPO grading, while optional, is performed by SEBI-registered credit rating agencies using a 1 for 4 fundamentals to 5 for strong fundamentals scale.
And this is not a recommendation to subscribe.
Absolutely not. The grading assesses the issuer's fundamentals and inherent business risk. It is explicitly not a recommendation to subscribe or a comment on the issue price.
That was the heaviest lift, the regulatory hurdle race. Now we can move into Section 6, detailing the types of public offers and the pricing mechanisms. We have the IPO and the FPO.
The initial public offer, or IPO, is the company's first public offer, leading to widespread shareholding and its initial listing. The further public offer, or FPO, is made by an issuer that's already listed, seeking either more capital or aiming to increase public shareholding after a lock-in period.
Let's dedicate a moment to the two components of an IPO, fresh issue versus offer for sale, or OFS. This is a common point of confusion for investors regarding where the money actually goes.
In a fresh issue, the company creates and issues new shares. The critical consequence is that the issued share capital expands, and the money raised goes directly into the hands of the company to be used for its stated objectives.
And this dilutes existing shareholders.
It does. It results in the dilution of existing shareholders' percentage holdings. For example, if a promoter held 50% of 1,000 shares, that's 500 shares, and the company issues 500 new shares, the total is now 1,500. The promoter still has 500 shares, but their percentage holding has dropped to 33.33%.
And the offer for sale is fundamentally different because it involves existing capital.
Correct.
Okay.
An OFS is defined as an offer of securities by existing shareholders, like promoters or early financial institutions to the public. Crucially, the share capital of the company does not change because no new shares are created.
The money goes to.
The proceeds go directly to the selling shareholders, not the company. This is purely an exit mechanism for early backers. A common example is government disinvestment in PSUs, where the government is the selling shareholder.
Moving on to pricing, we have the traditional fixed price issue.
In the fixed price method, the exact price is determined upfront by the issuer and the lead manager. Investors know the price precisely when they submit their application. The major drawback, though, is that the true demand for the issue is only known after the issue closes, which can lead to potential mispricing or inefficient capital raising.
The modern preferred method is the book-built issue.
Book building is defined as a process to gauge, elicit, and formally build up demand, and by doing so, assessing the most efficient price for the securities. The issuer, guided by the BRLM, sets a price band range with a floor price and a cap price, within which the final price is permitted to move.
And investors bid within that band.
Yes, for a specific volume and at a specific price.
The outcome of this bidding process is the cutoff price.
This is the single final price at which the issue gets successfully subscribed. All investors who bid at or above the cutoff price are eligible for allotment.
And retail investors have a simple option.
They do. They can submit their application at the cutoff price, which means they agree to pay whatever the final discovered price is. This ensures they participate, regardless of small price movements within the band.
And a small benefit is often passed to the retail applicant.
Yes. Book-built issues may offer an allotment discount to retail investors, though this discount is capped and cannot exceed 10% of the price allotted to other categories.
Now, the most critical part of this section for the exam, the book-building allocation patterns. These numerical thresholds dictate who gets what, and they are dependent on whether the issuer passed the big three eligibility tests.
Let's start with the standard scenario, where the issuer meets the eligibility criteria, the NTA, profit, and net worth tests. The allocation is designed to ensure wide distribution.
Okay, so what's the breakdown?
Retail individual investors, RIIs, get a minimum of 35%. This ensures significant retail participation. Non-institutional investors, NIIs, get a minimum of 15%. And qualified institutional buyers, QIBs, are restricted to a maximum of 50%. And of this 50%, a small but important reservation exists. 5% must be reserved for mutual funds.
Now, what happens if the issuer does not meet the financial eligibility criteria? We already established they must rely on QIB validation.
The allocation pattern shifts drastically to reflect that required institutional confidence.
How so?
Retail individual investors, the RIIs, are capped at no more than 10%. Non-institutional investors, NIIs, are capped at no more than 15%. And qualified institutional buyers, QIBs, must receive a minimum of 75%.
A huge jump.
It ensures the institutional backing is robust, and again, 5% of that QIB portion is reserved for mutual funds.
We also need to remember the sub-allocation structure within the NII category, which promotes fairness among mid-size and mega HNIs.
This split ensures distribution within the NIB-HNI pool. 1/3 of the NII portion is reserved for applicants applying for amounts greater than 2 lakhs and less than or equal to 10 lakhs.
Okay.
The remaining 2/3 is reserved for applicants with an application size greater than 10 lakh rupees. This prevents the largest HNIs from completely dominating the smaller NIB applications.
And finally, if the issue is not book-built, so if it's a fixed price issue, the allocation reverts to a simpler rule.
For non-book build issues, a minimum of 50% must be reserved for RIIs, and the remaining portion goes to all other categories of investors combined.
That detail on allocation is invaluable. Section 7 covers the step-by-step public issue process and the mandatory application mechanism, ASBA. This sequence is key to understanding the life cycle of the IPO.
The journey begins internally. The issuer requires formal board and shareholders' resolutions to approve the fundraising. This is followed by the immediate appointment of the lead manager, who then coordinates the entire syndicate, selecting the R&T agents, bankers, brokers, and underwriters.
Before the public offer can even be considered, regulatory prerequisites must be met.
Yes. The issuer must get, in principle, listing approval from the stock exchange and finalize agreements with the depositories for the admission of the securities into dematerialized form. Then comes the regulatory filing. The draft prospectus is submitted to SEBI for comment and observation.
Once SEBI's observations are incorporated, the final legally binding document is created.
The final prospectus, which includes the signed due diligence certificate from the lead manager, is filed with the Registrar of Companies, the ROEC. Only then do the external marketing activities commence roadshows, advertisements, and analyst meetings, followed by the dispatch of application forms and the abridged prospectus to potential investors.
When the issue opens, the bids flow through various authorized channels, brokers, DPs, and the crucial self-certified syndicate banks, or SCSBs. The payment process is standardized and, since 2016, mandatory across all public issues.
It is mandatory to use ASBA. That stands for Applications Supported by Blocked Amount.
A huge change.
It was a revolutionary change that addressed the massive logistical headache of handling physical checks and processing billions in refunds. ASBA is an application coupled with an authorization to the SCSB to simply block the application money in the investor's bank account. Crucially, the funds are released only upon successful allotment.
And if the application is rejected?
If the application is rejected or scaled down, the money is immediately unblocked, often earning interest in the investor's account until the shares are transferred.
And for the smallest retail applicants, there's a further integration requirement.
Effective May 1, 2022, retail individual investors, RIIs, applying for amounts up to 5 lakh rupees must use UPI in conjunction with ASBA. This digitizes and accelerates the mandate process even further, providing near instantaneous blocking and unblocking of funds.
Okay.
Investors typically bid for the minimum bid lot, which usually corresponds to an application value between 10,000 and 15,000 rupees.
Right.
Bids can be revised or modified before the issue closes.
Once the issue closes, the BRLM determines the cutoff price and the basis of allotment is finalized.
The basis of allotment is the pattern used to distribute shares among the different applicant categories. Now, if the issue is undersubscribed or fully subscribed, the process is simple. Every successful applicant gets the full number of shares they applied for, provided their bid was at or above the cutoff.
The complexity arises during oversubscription.
Yes. If oversubscribed, shares are allotted on a proportionate basis. The applications are first collated by category RII, NII, QIB. Then the oversubscription ratio is calculated separately for each category. That ratio determines the minimum allotment for large applicants, while small applicants are often subject to lottery or minimum guaranteed allotment rules.
And then the process finalizes.
Yes. Once the basis is finalized, shares are credited, funds are unblocked for rejected portions, and listing commences.
To protect the share price immediately after listing, especially in a book-built issue, the issuer can use the green shoe option, or GSO. This is essentially stock price insurance.
That's a great analogy. The GSO is an option to allot equity shares in excess of the shares offered, up to 15% of the original issue size. The funds generated from this additional allotment are then specifically kept aside to buy back shares in the secondary market if the stock price falls below the issue price post-listing.
So it's a price stabilization mechanism.
Exactly. And this price stabilization activity is a key feature, but it's strictly limited to a period of 30 days from the listing day.
Section 8 moves into the core documentation, the prospectus. What must this document contain to meet regulatory standards?
The prospectus is defined as the document inviting offers from the public for the subscription or purchase of shares or debentures. Its content is exhaustive. Comprehensive details of the issuer, the promoters, the directors, the exact objective of the issue, how the money will be spent.
The works.
Everything. The terms, the full financial history, required regulatory disclosures, and most critically, a full summary of the specific risk factors unique to the company and the industry.
For a book-built issue, The document filed before the final price is known as the Red Herring Prospectus, or RHP.
Think of the RHP as a restaurant menu where the item descriptions are perfect, but the prices haven't been written in yet.
I like that.
It contains everything the final prospectus does, except the final issue price and the exact number of shares being offered, as those variables are determined by the market bidding process. Once the price is discovered, the final price and volume are incorporated, and the document becomes the final prospectus filed with the ROC.
SEBI retains the power to reject the draft offer document. This isn't just a rubber stamp process. What are the grounds for rejection?
SEBI can reject the draft if the proposed usage of the proceeds is unclear, speculative, or doesn't result in the creation of tangible assets, which links back to that NTA rule.
Okay.
Rejection can also occur if the stated business model is deemed misleading, if the financial statements are inconsistent, or if ongoing litigation poses a material risk to the continuity of the business.
Once the issue is successfully concluded, listing of shares is mandatory for public issues.
Listing is the formal admission of that security into a recognized public trading system. This requires the company to sign a formal listing agreement with the stock exchange, pay requisite fees, and adhere to continuous disclosure and corporate governance rules. Listing is the key driver that brings crucial liquidity to the investment and enables robust, fair price discovery.
Let's review the rights issue of shares again. We noted its primary purpose is anti-dilution.
It's a mechanism to ensure fairness to existing shareholders when a company raises fresh capital. If the company needs capital, instead of immediately selling new shares to the public, it offers them first to existing owners in a proportion approved by the board, say 1 share for every 2 held. This prevents the proportional dilution of their ownership stake.
What are the regulatory specifics for a rights issue?
The issuer files a draft letter of offer with SEBI, followed by the dispatch of an abridged letter to existing investors. The issue must be open for subscription for not less than 7 days and not exceeding 30 days. And crucially, the company must fix a record date to formally determine which existing shareholders are eligible for the rights entitlements.
And a unique feature of the rights issue is the tradability of the entitlement itself.
Yes, the rights entitlements, or REs, are credited as a separate, distinct security in the investor's DMAT account. An investor who doesn't wish to subscribe can sell or renounce these entitlements on the stock exchange to another investor.
And that buyer can then use them to subscribe.
Exactly. Trading in these REs ceases a few days before the official subscription period ends, and all payments for the rights issue must also be made via ASBA.
We now pivot to debt in Section 9, public issue of debt securities. While the general flow is similar to equity, the specific regulations reflect the debt holder's different risk profile.
Debt issues are primarily governed by the Companies Act and the SEBI, Issue and Listing of Non-Convertible Securities Regulations, 2021. A major regulatory distinction here is that an unlisted company, one that hasn't successfully completed an IPO, can still make a public issue of debentures and list them, provided they meet the relevant debt norms.
The offer document process includes a unique efficiency tool for large debt issuers, the shelf prospectus.
The shelf prospectus is a major regulatory convenience permitted for eligible entities like public financial institutions, scheduled banks, and large NBFCs. It allows them to file one comprehensive document with the ROC for multiple issues over a predefined period, often a year.
So for each new issue?
For each subsequent issue within that period, they only need to file a tranche prospectus, which contains just the specific details of that particular issue, like the coupon rate and tenor, and any material changes since the shelf prospectus was filed.
Listing is mandatory, and credit rating is equally crucial for debt instruments.
Listing on a stock exchange is mandatory for public debt issues. And due to the high risk associated with corporate debt, a credit rating must be obtained from at least one SEBI-registered rating agency. If the issuer gets multiple ratings, all of them must be disclosed in the offer document, even if one is less favorable than the others.
Full transparency.
Full transparency.
The minimum subscription requirement is also different from equity's 90% rule.
For public debt issues, the minimum subscription threshold is set at 75% of the base issue size. If this threshold is failed, the entire blocked application monies must be unblocked or refunded within the stipulated time frame, and interest must be paid for any delays. The only notable exception to this 75% limit are specified tax-free bonds.
Other mandatory requirements unique to debt are the debenture trustees and the creation of a debenture redemption reserve, or DRR.
The mandatory appointment of debenture trustees ensures continuous oversight protecting creditor interests. If the debt is secured, the trustees must confirm that the property charged as security is adequate and legally protected.
And the DRR.
The issuer must also create a debenture redemption reserve by transferring a portion of profits annually until redemption. This acts as a sinking fund, ensuring the issuer has sufficient liquid resources available when the principal amount is due to be repaid.
While corporate debt follows the general equity issue process, the process for government securities is managed entirely by the RBI via auctions.
This is a distinct process involving two types of bidding. Competitive bidding is restricted to participants who maintain both a current and subsidiary general ledger, or SGL, account with the RBI. So that's primarily scheduled commercial banks and primary dealers. They actively bid the specific yield or price they are willing to accept.
What is the mechanism for smaller or less sophisticated investors?
They utilize non-competitive bidding. This route is open to entities lacking SGL accounts or specific technical expertise, like cooperative banks, smaller NBFCs, mutual funds, and smaller companies. Critically, they receive allotment at the weighted average price or yield determined by the successful competitive bids.
So it removes the guesswork.
It removes the requirement for them to accurately predict market rates.
And how does the retail investor access GSECs?
Retail investors can participate via recognized stock exchanges using the non-competitive bidding route. The stock exchange acts as an aggregator, consolidating all the small retail orders into a single, large, non-competitive bids submitted to the RBI, and then handles the final investor-wise allocation based on the discovered average price.
That distinction between corporate debt and GSECs is key. Our final section focuses on private placements, the methods of capital raising that bypass the extensive public regulatory hurdles.
A private placement is defined as an offer made to a select group of institutional or eligible investors. Under the Companies Act 2013, this is strictly limited to not more than 50 persons.
50.
The key advantages are clear: significantly less regulatory compliance, less time-consuming, and highly cost-efficient compared to a full IPO. The issuer is explicitly restricted from advertising the issue, and payment must strictly be through verifiable banking channels.
We mentioned preferential allotment earlier.
A preferential allotment is a type of private placement of shares or convertible debt, specifically made by a listed company. It requires shareholder resolution, and the pricing must be determined by a SEBI formula, usually related to the recent average market price. Promoters and strategic investors subscribing often face mandatory lock-in periods.
And the most important institutional private placement mechanism is the Qualified Institutions Placement, or QIP.
A QIP is a streamlined way for a listed issuer to issue eligible securities directly to QIBs without a full public offering. To be eligible, the company must pass a special resolution and must have been listed for at least 1 year prior to issuing the notice.
QIPs have a significant strategic use for promoters.
They're often utilized by promoters to help achieve the mandatory minimum public shareholding requirement of 25% without needing to go through the lengthy IPO process. In terms of allocation, a minimum of 10% of eligible securities must be allotted to mutual funds. Investors must use ASBA, and the allotted shares can only be sold on a recognized stock exchange after a lock-in period of 1 year from the allotment date.
Finally, let's address the mechanism designed to bring transparency to the rapidly growing corporate debt private placement market, the electronic book provider, or EBP.
The EBP platform is SEBI's way of injecting price discovery and transparency into wholesale corporate debt. The use of EBP is mandatory, but only once specific issuance thresholds are crossed. This is the regulator drawing a clear line in the sand, saying that once corporate debt placements reach a certain scale, they are too systemically important to be handled entirely privately.
Let's detail the mandatory use thresholds. These numerical figures are critical for the exam.
EBP use is compulsory if 1. A single debt issue is greater than or equal to 50 crore rupees. 2. A shelf issue cumulatively aggregates to 50 crore or more in a financial year. And 3. Subsequent issues in a financial year, even if initially small, aggregate to 50 crore or more.
So that 50 crore number is the trigger.
It's the trigger.
The EBP process itself requires strict adherence to timelines.
Issuers must upload all necessary documents: the private placement memorandum, the term sheet on the EBP platform at least 2 working days prior to the issue opening, or 5 working days if they are first-time issuers on the platform.
Okay.
Furthermore, there's a bidding limit to ensure wide participation. An eligible participant cannot bid for more than 100 crore rupees or 5% of the base issue size, whichever amount is lower, if they're bidding through arrangers.
The system determines the success of the bids based on price priority.
It uses price time priority if the coupon is fixed, or yield time priority if the coupon is discovered. The cutoff price or yield is automatically calculated by the system, ensuring the most favorable rates for the issuer receive allotment first.
That brings us to the end of our comprehensive deep dive into the primary market. We've covered the entire life cycle of capital, from the initial decision to go public to the stringent regulatory hurdles of the big three eligibility criteria, the mechanisms for pricing, and the mandatory efficiency of ASBA.
We've hit every crucial numerical threshold: the 2 lakh rupee RII limit, the 20% minimum promoter contribution and its various lock-in periods, 18 months versus 3 years, the 90% minimum subscription for equity, the debt minimum of 75%, and that 50 crore EBP trigger. Mastery of these specific figures, coupled with understanding the why, the regulatory rationale, is absolutely essential for success.
So what does this complex, meticulous framework tell us about the ultimate responsibility in the primary market?
The NISM material makes one subtle but powerful statement that we must reiterate. While SEBI and RBI have erected this elaborate structure to mandate fair procedures, adequate disclosure, and defined rights for all parties, there is ultimately no assurance of return, risk, safety, or security. The regulatory environment ensures a highly structured, scrutinized, and fair start line for raising capital, using mechanisms like mandatory ASBA and strict listing norms. But the price discovery, the assessment of risk, and the outcome of the investment are entirely in the hands of the market participants and the investors themselves. The regulator ensures fairness, not profit.
A crucial distinction to keep in mind, both for the exam and for the real world of finance. Thank you for walking us through this comprehensive material. We encourage you to actively test your knowledge against these specific figures and processes immediately.